Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today is the man himself, not in Texas, but he's where? Michael Becker, where are you at today?
I'm in Hawaii, and it's not 100 degrees here. So working remote for at least another few days, and we'll be heading back to Texas soon.
That's great. Okay. Also joining us in the podcast, the number one loan officer with Old Capital, Ricardo Hinojosa. Ricardo, how are you?
Doing good, Paul. Good to be here.
Good. Let's talk to Michael Ware. Michael Ware is with Marcus Millichap, IPA. Michael has been a friend of ours for a long period of time. I've known Michael sell institutional properties, but when he used to sell crappy C-class properties a long time ago, and he's made that transition a number of years ago to the nice amenity-rich properties here in the Dallas-Fort Worth area. He is a pleasure to talk to. He's a wealth of information about what's going on in multifamily, especially the institutional side. And I'm going to turn it over to Michael Becker. Michael, let's go with the questions.
Hey, Ware, thanks for coming back on the podcast. I know you've been on before, but those that don't know who you are, maybe a quick little professional background on yourself. Tell us a little bit about what you guys do.
Yeah, good afternoon, and thanks for having me on the show, fellas. It's good to be here. So yeah, that's an accurate statement. I started at M&M in 2005, coming up honestly on 20 years in October, which is hard to believe, and I'm kind of dating myself there. So not the first cycle I've seen in the business, but yeah, I started in Bachman Lake, South Irving, East Dallas, and South Dallas. So
all the glorious areas,
the glorious submarkets,
Texas.
A little bit different back then. You know, we used to take our own photos, and people I think thought we were feds at some of these properties and would just run from us in our suit and ties. So it's been an interesting journey, but we still handle everything from, new Class A high rise to, 3-story surface park and even 2-story low density 70s and 80s products. And it's still a lot of our bread and butter, and we still have some really good clients that we've known for almost 20 years now. It's been a fun journey.
Yeah, it has been. So I've been fortunate enough to transact with you guys numerous times over the years. So Mike's been, both personal and professional friends of the team here. So just thought we kind of spend today really talking about state of the market and kind of hearing from you what you're seeing on the ground. It seems like it's very disparate out there. There's some really good things going on, some green shoots, and there's still some issues and problems as well. What do you guys kind of just generally, just kind of high level, what do you see? And then we kind of drill down kind of across the DFW metropolitan area and the different aspects or segments of the multifamily space. What are you kind of seeing right now?
Absolutely. And it's a great question. And as we always say in our shop, we'll go macro to micro. So high level, I think that most people are probably just fatigued, right? You've seen just operational headwind, an incredible amount of supply. If you read any of the news, it's usually pretty pessimistic, and it's hard to kind of lose track of where we're at. I think being in multifamily in DFW and being local, you're kind of in the fishbowl and it's easy to get down, but you talk to people from around the United States or even internationally, and I think their view is very different from ours as locals, and the fact that we still have the best population and job growth in the country, arguably the planet, top 5. I think we've gotten through peak supply, which was last year, which you talk to some of the more silver-haired folks and they'll tell you it's the largest amount of delivery since 1984. But we've weathered that. We absorbed all of it. This year is a little bit of a supply hangover, and getting into next year, we're going from being an oversupplied market to quickly undersupplied, while we also have a lack of, I think, attainable and affordable housing in the single family side of the equation. So I like to think of it in historical context as 2022 obviously was a huge year, right? It was the record trade volume for DFW. We did $25 billion in multifamily trade volume for everything from A, B to C product. In 2023, we took a pretty significant drop off and did roughly $5 billion. So 20% of the previous volume, right? I mean, falling off a cliff. In 2024, $6 to $7 billion. And I think in this year, the way everyone's tracking between us and our competitors, I think we're going to probably see $8 to $10 billion in trade volume. So a steady climb from the trough. And I think the way, again, we look at it is you're seeing reentry of institutional capital into the DFW market. That started taking place last spring. And I think in a traditional cycle, it's usually pretty top heavy. The institutional money re-enters the market, starts at the Class A and starts trickling down through workforce. And so I think we are entering recovery phase. I think we're still dealing with a little bit of supply, high level. You've seen the concessions kind of creep up everywhere from new product down to the B and even traditional workforce. And so it's getting pretty chippy out there. Everyone's playing defense. Everyone's trying to hold the line on operations. But the good news is, if you look at DFW again, relative to like a Austin or a San Antonio or a Phoenix or a Nashville, these traditional Sunbelt markets where capital usually lands, we are the belle of the ball right now, just in terms of the quickest back to a return of fundamentals and kind of operational tailwind. So I think that's the silver lining, is we'll be the first out. And again, our 10-year demand average is around 26,000 units. Next year, we're not going to meet that demand level of supply. And if you talk to a lot of the developers, it's really, really difficult for them to capitalize deals. So now we're going into a 2 or 3 year stretch where you're going to have a significant challenge providing housing units for all these renters that are still moving to DFW. And so I think we're going to not only see rent growth, but really significant rent growth. So we're excited about that. Just a matter of getting there.
So what are you seeing? So to my view, it looks like if the deal is well located, prettiest, newest, shiniest thing on the block, it's every institution beat themselves up to go buy it. If you start getting off on location or fundamentals on the deal or just some commodity stuff in the northern suburbs, it falls off precipitously, and then you kind of work your way down. But what are you kind of seeing focused on Class A? What is capturing attention and what's missing?
That's a good question. And we track that pretty tenaciously, just try to figure out really where's the money going. So we'll start to 3 major buckets, and we track all of it as your core plus, and value add. Again, I feel like the market has fundamentally shifted to where even these large institutions have buckets of money across the board, right? So you've got impact funds, workforce, and then your traditional core plus and core. The Odyssey funds have been a little muted. Your traditional core and ultra core buyers, I feel like, have been selectively putting money out with separate accounts. Just the redemption queues in the Odyssey space are still elevated. We did sit in on a report 2 or 3 weeks ago where it's like they're finally starting to show some signs of positive growth on appreciation and operations on their national kind of, feedback or portfolios. So that's a good sign. I think as some of that core money loosens up, everyone, it seems like, has been trying to buy core plus and or shoehorn value add into every deal, because that's where the money is right now. It's just opportunistic. I think for a deal to start again top down for Class A, yeah, you're right, Mike. It has to check the ISDs, the demos, the proximity to the CBD. What is the rent versus own delta? And it's the widest it's ever been in Dallas, I think, historically. If you look at what the cost is on a monthly basis to own a home versus to rent. We're looking at discount to replacement costs as another hot topic in investment committee. We're talking to a JV partner. I think as a percentage of rent to income, affordability has actually gone up in DFW. We track that pretty closely. You've had wage growth outpace rent growth the last 2 years. So again, anecdotally, people, I think, complain. It's like, oh, we're pushing our tenants, but statistically, they're actually getting a little bit of a break, again, with their incomes going up and rents going flat. I think that for it to qualify for a Class A deal, for real big institutions to hop, it's got to check a lot of boxes. As you go into more of what you said, the kind of the more commoditized or like concentric rings and the outer suburbs, and I think people are chasing yield. People ask us right now, what is Dallas for, a going-in yield market? We're approximately at a 5, plus or minus 20 bips, either way, depending on what we just talked about and how many boxes does it check, or how clean or stabilized are the operations. Is it coming out of lease up? Are there 4 more deals leasing up, within 2 miles? What do the concession stores look like? So, I just got off a call, and I would say it's the same thing. It's very nuanced. I think every deal has gotten very micro. In 2021, 2022, people were looking at the macro growth and saying, hey, look, let's make a bet. Everything's going to go up. And now I think people are really leaning into the 1, 3, 5 mile radius and really figuring out what is going on in the local submarket and what can I lean into as part of my narrative for the story. So that's been interesting. We do supply maps now for every deal and go drive around and really figure out, okay, what's delivering on a quarter by quarter basis and when can we expect concessions to burn. I think to kind of round that question out, when you're getting into workforce right now, that has been traditionally a little more difficult just with the capital raise. And I also think from an operational standpoint, we have seen elevated delinquency and a little higher physical vacancy than we're traditionally used to. A lot of the JP courts have been more tenant-friendly than landlord-friendly, so it's been harder to kind of churn non-paying tenants out and backfill them with tenants who are going to pay. That's getting better from what we're hearing. But, in that space, you've got a lot of people who maybe aren't as well capitalized and or there are some deals, as we all know, in limbo right now that maybe it goes back to the lender, maybe it doesn't, maybe they work it out. So I think there's just a lot of uncertainty in the workforce space. And again, a little more disruption in the operations. And so from a pricing standpoint and valuation standpoint, I think there's a lot more dispersion and really opinions from the executives that are buying those types of deals as to, what is the thesis? What is really going to happen in this space? Are we done correcting? We found bottom of valuations. When our operations going to turn? So that's become, I would say, even probably more nuanced than a lot of the Class A and people really trying to find deals. Again, just a quick observation in that space, I think you've seen a lot of the professional operators in the last 12 to 18 months try to move up stack as there was a void from the institutional capital. And now that the institutions are coming back, I think some of those operators are coming back down into your traditional 80s and 90s product, which is good because I think there's been kind of a void of really reliable operators that can go close deals. And I think that over the last 2 to 2.5 years, it's taken a lot of sellers time to kind of mentally readjust expectations and be able to meet market. And I think you're starting to see a lot of that happen today. And I think
are you seeing actual better heeled or established groups trade or just poke around or what's happened?
Yeah. So on the sell side, it's a litany of reasons for them selling. I think a lot of them are either in a good position, right? They bought it right in like the late teens. They've had a good basis. They've harvested the deal and they're saying, hey, we can exit and actually make a good return and go redeploy capital right now and probably buy a better deal. There are some people who I think bought at peak on floaters and they know they got in and it's like, the first year or two you're trying to hold on and stay optimistic, which I think is every real estate operator's kind of go-to personality. And I think you kind of run the math and say, hey, look, this is a bad beat. We're not going to make a lot of money in this deal. What are we doing? And so I think they're making executive decisions and saying it's time to rubber's meeting the road here. What do we want to do? Are we going to try to prolong this or should we ripcord, take back what equity we have and go make money into what we consider is going to be a really bullish run operationally? So I think you've seen a lot of operators kind of come to those terms and go to their equity and say, look, this is kind of a stinker, but like, let's make a decision here and move. And so that has finally started happening this year. And I think that might have been pushed along a little bit by the lenders now being a little more reluctant to either give more term, or they were focused for the last 2 or 3 years on a lot of office product they took back on the West Coast and the Northeast. And I think all eyes on the lender side have turned to Sunbelt multifamily. So they've kind of shored up a lot of those issues in their office product. And now it's like, okay, we got to figure out what we're dealing with on the multi side. And so a lot of lenders have been a little more proactive this year and have been very direct with, I think, their sponsors or borrowers saying there's no more time after this. We got to figure something out. So I think that's kind of spurring a lot of it. And slowly buyers and sellers have taken a step towards each other and the bid-ask gap is getting narrower.
So, Michael, right now, my professional opinion right now, it's been very tough to raise equity. We talked a little bit about trying to raise institutional equity has been there. I mean, I can't tell you how many different IPA coming soon, just sold emails I get from your group. I mean, you guys are just knocking the ball out of the park. And I can imagine a lot of the institutional buyers are providing the equity. We just talked a little bit about why are sellers selling, but again, do you see buyers in the syndication model coming in with equity? Are they able to raise equity? I mean, I'm not talking about groups like Michael's SPI. I'm talking about just regular run-of-the-mill groups that want to buy a $15, $20 million or $25 million property. Can they assemble the cash? And then I'll ask that same question to Ricardo about what he's seeing.
Yeah, it's a great question. And it's one that keeps us up at night. And I feel like in all of our if you've been through our process, we run the marketing process and the campaign, we field offers, we go to best and final, and we get into buyer calls. And I feel like the crux of our buyer calls these days is, who has the money? And if you don't have the money, where are you going to get it from? And, not only tell us, but show us. and show us over and over again. Joking aside, that has been the toughest part of it, I think, for everybody, both institutional and private, is, if it's not discretionary capital or fund money, where's it coming from? What kind of commitments do you have? And I would say that, again, that's part of our qualifying process. I think a lot of that has to do with the brokers doing their job and setting realistic expectations with their seller clients up front. 23 was difficult, right? I mean, it was like the tides were changing. So it's a lot of murkiness and a lot of uncertainty and really no footing and data points to go off of. It was such a just quick and significant correction. I think now, though, if the brokers are doing their jobs, we're listening to the buyers. I know sometimes it may not seem like it. We're just calling and trying to get pricing, but we listen to the feedback. We listen to the feedback from where their potential partners or the investment committees are saying and where the issues are. And we try to, quite literally in real time, take those questionnaires and we build it into our Monday pricing meetings to go to sellers. And it's like, if you want to meet the market, this is where you need to be. So I feel like as long as we do a good job setting that expectation up front and you have a realistic seller, there is money for deals. Now, if you're going and stretching on a workforce deal, that's already pretty hairy. You've got razor thin margins between your debt and your in-place yield, and it's just like, okay, what else in the world can go wrong? I think a lot of people don't feel good about that, and they're not necessarily motivated to go raise money. But, again, it's selling some yield right now with the potential upside of what's coming and arguably the best macro market. There's still money. I know this is a long-winded answer. I will say directly, it's a lot of new money, Paul. There are groups showing up that we have just, quite frankly, never heard of. So we're having to do homework and actually call on the referrals and figure out, hey, where are they from? And a lot of times it's a group out of New York who's like, hey, look, we were doing retail and office, and now we're apartment guys in Texas. So yeah, it's kind of wild, but we're literally turning over every stone and just talking to any buyer because there's a lot of capital that needs to get out. And again, being local, it's easy to be negative, but to a lot of these outsiders, this is the best investment, I think, in terms of just product type and location that they're looking at. So
I agree. And then, Ricardo, what's your 2 cents about raising capital these days? I'm not talking about $1 million or $2 million. I'm talking about significant capital.
That's our biggest challenge right now. Anything over, and I'm talking, local groups, medium-sized syndicators, anything over a $10 million equity raise is really challenging right now. But we do have a lot of clients that are getting it done. Michael, the question I have for you is we get a lot, like most of our clients, we do a lot in the B and C space. And you'd mentioned earlier that folks are looking for that 5% yield. A lot of our clients come to us with, hey, here's our box. We love to go newer. We'd love to, get an A-class deal, but we can't seem to find the yield on A-class. And a lot of them are looking for, hey, we need to find a stabilized deal that's getting where we're at 65% or better leverage, and we're going in, as close to a 6 cap as possible. Is there an A-class deal? Or if somebody's asking you, hey, I want to go newer, but I need yield, what type of deal or should they be, what deal can make sense? An A-class space, or is it, hey, right now, at this point in the market, stay in the B and C? It likely doesn't make sense.
Yeah. So I think if you're looking to kiss the six, as we so delicately put it, you need to focus on workforce. So right now we are telling clients, roughly speaking, you need to be between an in-place 5.5 and a 6, tax adjusted if you're an 80s product, or kind of late 70s individual HVACs, not too much deferred or a ton of hair where someone's going to go spend $2 or $3 million just trying to get the place in an operating condition. So I think that gives them a little bit of protection on their downside. If you can go prove up the renovation premiums, that's a cherry on top. I think otherwise people are taking that first year to first 18 months to really just right size the ship and taking your economic from the low to mid 80s to low 90s. And then it's okay. We've got our arms around this deal. We think we've got everything figured out. We've got some yield in place. Now can we go start spending 10, 15, 20 a door and try to go chase $200 pops? So that's where I think they can probably get that better yield. Again, in the Class A space, I think that the supply story is there. People see the growth coming. And I think where it's just really tough for those privates to compete is just the bigger capital. They've got so much pent up capital that they've got to put out. That again, if they find a good story, and it's anywhere close to a 5 or just inside of it, I think they're willing to put it out and bank on rent growth coming in year 2 of the hold.
No, that's what we're seeing. It's just so tough to compete against those institutions right now.
Yeah.
So we end up in the B and C space. So
Yeah. So what's
that
crazy
works.
about that, like to even kind of further the point, we've had some institutions go on deals, and I feel like we take a pretty thorough underwrite. But one deal we just closed, the buyer actually beat up our NOI and was willing to take, at least on their paper, a lower going in yield, like mid to low fours on their NOI, because he's like, I just want to be right. I can't go to my quarterly meeting and be wrong, right, on actual operations. So that's, to me, was kind of interesting state of mind and kind of where they're at. Is we just have to get it right. We can't go mark down, but we love the real estate. To Mike's point earlier, it checks all the boxes. So like we'll take less yield going into it. We feel good about the NOI though, and the year one, and let's put the money up. That's been kind of some interesting insight.
Yeah, Becker and SBI have really been buying Class A properties for the last number of years, and I think they're in the cul-de-sac of multifamily these days, and maybe turning around a little bit and looking at B and C, or maybe a B minus, to see if they can get up to a B property. Michael, what's your theme or thesis these days?
It just seems like the pendulum's shifted dramatically. Obviously, just, for years it was where the cap rates were on top of each other, where, when I started, there was 300 basis point spread between the top and the bottom of the grade. And all of a sudden that came, virtually on top of each other, as we talked about for years on this podcast. Just didn't make any sense. And then that culminated in 2022. And then we've been kind of gapping out where the cap rate's much stickier on the top of the grade and blowing out on the bottom of the grade. And it seems like we're probably 200 basis points wide right now. Maybe there's more to go. I don't know. Probably is. It's really hard to underwrite any cap rate on anything that's old, that's willing to trade right now, because where's your collections? Where's your delinquency? What's your tax number? I mean, those are all just major moving targets right now. But it seems like the better quality, better located stuff feels like that's probably a reasonable entry point if you're buying a well-located 80s deal that's got decent collection history. The stuff that's real dirty locations and hairy product, or in the inferior physical components like, aluminum wiring or chillers. I mean, those deals are just, I don't know. You guys are selling them there no bid or close to no bid, at least not an acceptable bid right now. So it just seems like it might be time to kind of draw a line in the sand and start making some bets, selectively on the right locations, and you're going to get paid with a better walk-in cap rate. There's some, some upside in a group like ours where we're trying to buy deals 12 years ago. We had no track record. I mean, I walk on a bid sheet, I'm winning 9 out of 10 if I'm competitive on price, I think. So I think we're better positioned than most, Paul. That's kind of what we're thinking. So I don't know if you have any thoughts on that thesis, Mike.
I love it. I mean, and I've been telling guys that for the last 12 months now. I mean, really, there's been kind of an exodus out of that middle market space. So the professional operators, you guys had the same strategies. Like, you move upstream a little bit. I think there's a lot of these professional operators that have the wherewithal, and I think they've got the chops to go into a buyer call and say, look, I'm your buyer. Like, I might be the second place bidder or even third place bidder, but I will ensure you will close this deal in 60 to 75 days with no hiccups. I'll see you at the finish. And I think that has a pretty compelling kind of power to it, because it has been tough. I mean, there's no denying it. The equity raise is a big question mark these days. I don't think they're making any more 80s product. And by and large, the macro story here is not slowing down in DFW. We still are the net in migration capital, and I think that's going to be a 20-year trend. So you start looking at some of this 80s product, to your point, if it's well located, checks a lot of boxes. I mean, what's the replacement cost? And sometimes you can't even make sense of that number, right? So infill and the dirt's too expensive. So I think we're going to become more of like a LA, an urban sprawl, and the density per acre of people is going to go significantly up. And it's like, hey, if you can own next to a CBD, on some good thoroughfares and actually have good, clean product, you're going to make money. And again, people have short memories. I think people got shell shocked a little bit from this last correction. But if you recall, 3 years ago, we were saying no to preemptive offers for over 200 a door for 80s product. Now we're trading that same product for 100 to 130 a door, roughly, right? And it's just, again, if we get back to half of that $25 billion year in trade volume, what does that do to natural compression as capital participation increases, as rents start pushing back up again? We're going to get a little bit of tax relief, it looks like, this year. Insurance is coming in. Who knows what automation is going to do to payroll? Maybe that helps out. So there's a lot of positive tailwinds, I think, just on the horizon. And I think for the people that are going to make smart moves in that middle market, there's less competition. You've got some sellers who are going to They're going to meet market this year, especially next year. Again, may or may not be lender incentivized to do so. But I think there's going to be a pretty healthy market and some really good buys coming up. That's my candid feedback on that.
Talk to any lenders that are willing to take below debt basis yet, or is everyone still holding the line at debt basis? Because it seems like a lot of these deals are virtually going out. The worst of the stuff is going out on the market at debt plus closing costs, and a lot of them aren't worth that, in my opinion. So they're not clearing. Do you have any thoughts on when those clear?
Yeah. So that's a very nuanced process. I think a lot of these lenders are well-heeled, and they're seeing all the macro of DFW as well. So for them, some of them may or may not know what they have or don't have yet. There might be some more capital-intensive projects that they haven't accounted for. It's like, hey, look, you kind of had an operator who's been less than liquid the last 2 years. You have some deferred maintenance, and you should probably visit the property. There are some lenders who are going to clear and actually make profit, or they're sneaking in operators very quietly and putting them on an incentive fee. We've seen some of that. But yeah, to your point, I think some of the lenders, they're trying to figure out what they still have, Mike, is probably the best way to put it. I think to some of them, they're incredulous when you tell them, this asset's probably worth less than the note balance. And so they're still processing. And some of them I think are just, the mentality is, hey, look, we know what we have. We're going to manage through this and wait for the market to recover. And we actually have the ability and the capital and the balance sheet to hold on to this for a year or two. And we believe macro's coming. And when that does, if we can get back to, a fraction of what these were selling, we're going to make money.
And maybe that's the difference is, last 15, 16 years ago was all bank debt and, kind of more traditional institutions where there was a lot of debt funds that are, kind of an arm of a large operator, like, some of the big REITs out there had that debt fund arms, and they're certainly positioned to operate better than, I was when I worked at Wells Fargo. That was not a good outcome if we took it back at Wells Fargo. So that's probably the two banks right there.
It's a telltale sign when you get on a call with a lender and they have their equity person sit on the call or come in the room as well. And it's like, hey, this is so-and-so. They run the equity side. And so you can kind of tell the strategy is maybe we're going to go a little longer on this deal, right or wrong. But again, like if they believe in that, in the bigger picture, in the macro, it's like, okay, I put a little bit of money into this. Again, wait for more participation, wait for operational growth. Like, what does our exit look like? Yeah. And they have the benefit, if they've got the balance sheet, of being able to be patient, whereas some operators today don't.
So looking forward, what are you kind of seeing as we get the second half of 25, and then what do you kind of expect as we go into 26? What's your kind of crystal ball on the top of the grade, bottom of the grade? What do you expect? How do you expect it to play out?
Yeah. So I think we just got through a ton of malaise. So again, NMHC kind of sets the tone, I think, for kind of just the mental outlook and maybe like the psychology of the market, right? And going into that, most of the institutions and who I call like your sophisticated capital were already saying, hey, look, we're probably going to be second half heavy. And we're going to see how things go this spring. So again, I think everyone being the eternal optimist that us real estate folks are is like, hey, this spring we're going to get it, right? And it just has been kind of flat. I mean, every T12 we're looking at, with the exception of a handful, are just kind of holding the line. And I think you can ask anybody in DFW, they're seeing the same thing. It's just, you got positive trade outs and new leases are relatively 0 to 1%. And it's like, if you have more retention than you don't, then you're still on the whole positive and you're holding on for dear life. We were expecting again to see a big spring. It didn't happen in April. May, everyone's closing May books, on the 20th. So we're going to start seeing how those look. But by and large, it's been a little flatter than everyone hoped. So I think what you're going to see is people are going to get through summer. There's been a lot of noise on the market too. You've got Liberation Day. Now we've got Iran, Israel, USA. Just on Saturday, it's like, okay, what does that do to global markets and the outlook? It's a lot of noise and disruption. Everyone's looking at Powell to maybe cut rates or not cut rates, and no one knows anymore. So I think people really are just kind of focusing on the month to month and just tracking on where we're going to start seeing some positive growth. My personal outlook is, again, we hit peak supply in October roughly of last year. We got to get through that. That takes months to get through a market as big as ours. I think in certain parts, we are starting to see green shoots. We're starting to see more positive trade outs. You've got the third parties like Axio and CoStar are starting to say 3, 4, 5% rent growth showing up in Q2, Q3 in these submarkets, which is good because a lot of buyers lean on those third parties, right? And not the broker or the internal kind of perspective. So again, long-winded answer. My educated guess is that I think later this year, we're going to start seeing some more growth. And I think for sure spring of next year, like we're going to be off to the races. And I can tell you just from our shop and like all of my partners, I mean, back half of 26, 27, 28, I think are going to be gangbusters. I mean, we were literally just look at the supply demand metrics. We're dropping off to roughly 19,000 units being delivered next year. You talk to any developer, it is a nightmare getting deals capitalized. They're still 50 bips wide, generally speaking. Equity wants a development yield of a 7. They're pulling every lever they can to get to a 6.5. Starts aren't happening, not nearly to the extent that they were. So I think if you, let's say they start just doing pursuit in January of next year, you're 18 to 24 months out from really any kind of significant amount of units hitting the ground in DFW. So we got a pretty lengthy runway, which is also simultaneously, like you look at the single family market, and I think the median house value went from 290 to like 415 approximately in DFW. And now you're having to commute 40 minutes to get to that first time, home. So I think you're going to start seeing a percentage of households kind of push back to the renter side, unfortunately, just by necessity. I mean, they can't afford that first time home, so the rent rolls are going to get stickier.
Ricardo had a question too. Ricardo?
Yeah. What's your advice, Michael? So, again, we've got a ton of clients that are in that kind of middle market space. Let's say you've got a buyer that, doesn't own 10,000 doors, maybe owns 500, 1,000 doors, but has a really good track record, maybe been in the business for 5 years, and they're really chomping at the bit, ready to compete with some of the big boys over the next 12 to 24 months. But again, they jump in, let's say they're there on price. How does a small group like that compete with somebody that owns 10,000 doors? I guess, what do you look for in that space?
Yeah. So I think organization and just really having your ducks in a row actually goes a long way. You'd be surprised how many people aren't as buttoned up as you think they should be for going and buying a 10, 20, $30 million deal. And you can kind of tell they're winging it. They haven't really had any equity conversations. You ask them like, hey, where's it coming from? They're like, well, we're talking to some guys. It's like, okay, that's not a great answer, right? Like, be concise, over communicate early and often. If you have a concern about the process, be open about it. I mean, everyone's in the same boat. We're all trying to make a living in the same industry and sector. And so to me, I think the best groups are the guys and gals who get on the phone and it's like, hey, look, here's how we're sizing the deal. Here's what we like about it. Here's what we don't like about it. Here's our concerns going into it. But this is what we're going to do to try to overcome it. And or look, we've underwritten the deal. These are the people who need to sign off and they've done it. And if you give us the opportunity, we're going to close this. Unless there's like some type of bugaboo that hops out and like a $3 million issue that you purposely hid from us, we're going to close the deal. And I think to me, like those are the calls that go best. And it's just demonstrating that you've done everything you possibly can to like run every trap on this deal. And it's like, barring no major outstanding events, we're good to go. Yeah. We're good on this price. And and even if it's like a token amount of hard earnest money, which as everyone knows, good attorneys can a lot of times get you. It's just like the good faith, like I guess token that you're throwing out there. And I don't know. It's a great question though, Ricardo. I mean, it's tough.
Yeah, no, it is tough. I mean, what do you not like to see? And when you ask the equity question, because that is the toughest thing right now. Yeah. What do you not like to see?
I'll tell you what I don't like is people who say they've never retraded a deal when we just heard stories of it, where it's like they're trying to get out on a technicality or just anything that can be considered less than like just above board or truthful. I mean, it's a small business, right? Like I would just say to your buyers, like, just assume people are talking to like some of your previous colleagues or partners and that someone knows them. So like it always gets out. Yeah, I think that's just my biggest pet peeve right now is just people trying to kind of, for lack of a better term, BS their way through like a pitch or a call or like say stuff that's not accurate. And then you do a little bit of homework, like 2 or 3 calls, and you find out that's not the case. Or maybe that the group you said has approved the deal hadn't even underwritten it, which has just happened. It's like, we're going to find out. Just be as honest as you can. Everyone's in the same boat right now. I guess the best thing I could say.
Maybe in reverse, the thing that's been kind of annoying me as a prospective buyer is when I get the term like, hey, my seller needs this price or they need that price. No one gives a shit what they need. The market doesn't care. Yeah. Like, it is what it is. The deal's going to clear where it clears. And just because you need something doesn't mean you're going to get it. So that's always frustrating. I'm sure you hear that all the time from your clients you're selling deals for. And it's probably frustrating to you as well. But that's like a turn off for me when I hear words like that coming my way.
Yeah. I mean, typically you just blame the equity, right? Everyone does.
Yeah.
Michael Becker, I don't know if we should get into it, but I would want to get Michael Ware's 2 cents on this HFC that's an issue within the state of Texas in the last month or so. and just kind of probing Michael Ware's mind. Can you let everybody know, Michael Becker, a little bit about what that traveling HFC is about, and any idea how many properties it's affected?
I mean, I think I heard somewhere in the 100, 120 range across the state, maybe a little more.
For almost 400.
400, maybe it's 120 in DFW, maybe is what I heard. And, the basically that got shut down a little over a month ago as we record this. And so how does that play out? The lawsuits are going to challenge the new law, and going to take months and months, I'm sure, if not years, to play out. So I'd imagine it's going to trigger some sales.
Why would, if the state of Texas had gotten its act together on property taxes, this wouldn't be an issue. But what a lot of operators explored was if you try to make your property affordable by bringing the average medium income down to the property, so you let more people maybe rent from you, and you're able to bring your rents down a little bit, you're able to, your property taxes abated. The state of Texas came in and which had been on the books for a while. They said that was okay. And a lot of people flocked like a bunch of birds to that understanding. They did a lot of putting stuff together so that would be in effect. And then the state of Texas came in with a thing called HB 21 and said, nope, we're not doing that anymore. And the governor signed it, and now it's going to go, I would think, just like Michael said, to litigation to sue the state. Michael, what's your take on the investment sales side? I mean, what are your partners and investors talking about with that?
Yeah, that is a dynamic issue right now. So I think our position has been to keep our ear to the ground and try to listen to as many of these smart, sophisticated groups out there that are actually speaking to the attorneys. It's interesting, in 2023, after the last ruling on the 303s, a lot of the firms put out legal positions 2 or 3 months after. I don't think any of the Texas firms have put out any kind of legal positions on this yet. We are hearing that there is a consortium of operators and possibly counties that are going to likely go into a class action lawsuit. I am not privy to the details of that, but I think it's a large swath of the, some big owners across Texas. Now, that being said, some people are in compliance and it's not going to affect them. Some people are not. I think it varies quite a bit on the structures that were put in place. And those seem to be different across the board. I don't think there's any of them that are apparently uniform. It's interesting. We're posting it. I think the biggest backlash for us so far is and I think wrong, but the negative perception across like the older PFCs that are done with local housing authorities who have been around since the 90s. So I think it's kind of created a lot of confusion. And it's interesting because sitting at the broker desk, you just hear from everybody. I think I've heard probably 100 versions of how this is going to play out, and all of them are pretty different. So we are definitely tracking the issue, trying to get to the bottom of it. We've got our legal team working on it. And I just think that, for now, it's a lot of unknowns. There is probably going to be some class action lawsuit taking place. And I think that for the PFCs in place, it's kind of created a little bit of reluctance or hesitancy, but the people that are in the affordable space are telling us it's not going to affect it and it's going to be business as usual. So those are the facts as we're taking and just kind of churning through and seeing what happens.
More to be talked about down the road. I agree that it's dark out there. There's not a lot of light about what's going to happen in the future.
Yeah.
So we'll have to see. But all I do know is that a lot of these operators that did these HFCs to try to make affordable housing available, and they were able to get their property taxes abated. I mean, really pushed down. Those guys are rich guys, and they're going to file lawsuits to that stays in place, or to whatever the state had originally said to hold them to that language. But if they don't, I mean, I think we'll see more that go to the market and have to be unwound, and we'll have to see where that goes. Let's just go around the table right here. Ricardo, any additional questions before we say goodbye to Michael Ware over at the Institutional Property Advisors Group within Marcus & Millichap in Dallas?
Nothing on my end. Appreciate it, Michael.
Great. Michael
Yeah,
Becker?
Mike, appreciate you hopping on and talking to us today. If someone wants to know a little bit more about, you gotta get on your list, see what kind of activity you guys have out there. What's the best way for someone to see the IPA Texas deals?
Yeah, absolutely.
Which will put a lot of stuff, emails in your box because of the amount of activity those guys are doing. Joey and Drew and Taylor, that whole team over there, busy, busy, busy. So I encourage anybody to get on their list just to see the activity levels of what's trading in the Dallas-Fort Worth and also the Texas market. I think you'll be very impressed. Again, this is higher level math. If you are only buying a 15 or 20 unit property, that's not really what this is. If you're buying a 150 to 300 unit building, that's what this is. If you're buying a Class A property and you want to go there, see what the market looks like when you're moving up from 8th grade to high school to college and see what that's all about. And that's what Michael does. Michael works in that A plus, B plus space.
Yeah. So I'll round that out and just say, the four partners in Dallas are myself, Drew Kyle, Joey Tuminello, and Taylor Hill. We are working on everything from newly built merchant product and Class A down to larger workforce. We do all the disciplines. If you want to get in touch with me specifically, you can reach me at mware@ipausa.com. That's MWARE at ipausa.com. And known these guys for a long time. It's been a fun run. I think that we are all together kind of been on the slog the last 2.5, 3 years, and everyone's ready for some fun times. And I think it's our genuine and candid position in our shop that it's coming. It's coming sooner than we all think. And I think if you remember post-COVID, how quickly that market turned around, I think it's going to be similar. Maybe not 18% rent growth, but we're going to have some really positive tailwinds in the near future. So I'm excited about the market, excited about the sector. We're in the right place at the right time.
And in the right city, right part of the state. And obviously the decline in the valuation of the market, as Michael Becker would say, is now's the opportunity to lean into multifamily. So it's the easiest, most understandable part of commercial real estate. So Michael Ware, we certainly do appreciate you spending some time with us. Ricardo Hinojosa, thank you. And of course, the governor of the great state of Texas real estate, Mr. Michael Becker, thanks for joining us. I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.